Only mode.
Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is where the trading week ending Feb 2nd, 2018. What an interesting week we had. We saw the Dow Friday fall about 2.5%. S&P was down about 2.1%. NASDAQ was down about 3.5%. And for the week, the Dow gave up a little over 4%. NASDAQ was almost 4%. And we saw the VIX move to the highest level since all the way going back November 2016. It closed around 17. And I guess the FOMA fear, the fear of missing out, is kind of subsiding just a little bit. But understand, we still got a very strong economy. We've got the fundamentals of earnings growth, top line numbers very strong, bottom line numbers very strong. Tax cuts have not even kicked in yet. We saw in the data coming out this Friday, one thing that got the markets a little bit worried was a little bit of a jump in wage growth. It's about, I think, 30 basis points jump, about 0.3%. It's the highest growth since June of 2009. So that kind of spooked the markets a little bit. But for our members, I've been talking about this now for about 3 months, 2 months. Probably tired of hearing me say it. If you're not a member, I highly encourage you to come in, get you on the right side of the markets. But I'm telling our members that we should be and we must be focusing on the 10-year rate, inflation, and the US dollar. We've seen since, I don't know, since 2008, 2009, a positive correlation between bonds, which is debt market, and equities or stock, meaning generally big money can add to these normal allocations across bonds and stock where if stocks are doing very well, then they can allocate, bonds don't really falter, or vice versa. But we're now seeing some big money, large fund portfolios. As they manage their portfolios, they have these risk parity strategies that says we need to allocate more to debt or allocate more to equity. But what happens when debt and equity both begin to fall? And we're seeing that. And I've been talking about this for a while now, with interest rates and the yield curve and the 10-year moving up above key levels. When they both start to fall, it really forces different allocation mix across big money funds. And what it forces them to do essentially is to relieve themselves of equity. They've got to deleverage, so to speak. And that means they're going to be selling both equity and bonds. So that highlights the sell-off in bonds and in equities. Now, we've seen this happen before in the markets. And typically the markets fall anywhere from a little over 4% to over 7 or 8%. Okay, so, and we're only down right now about 4% in the Dow and NASDAQ, a little over 3, S&P down just a little bit, but not too much. Okay, so we've had right now about 404 days in the S&P that we've gone without a 5% pullback. And moving down just another 30 points or so in the S&P handles, 30 handles or so will get us down to that 5% pullback. We've gone 404 days. That's decades old record, folks. The S&P right now still trades at about 17.7 times forward earnings. And I say forward earnings because there's still strong earnings growth projections when these tax cuts come in. So that's why in our group, we are still in a buy the dip. Okay. I think momentum could carry us a little bit lower, but that's kind of what I'm seeing right now. The Feds, their stated objective of basically reversing their financial stimulus is going to cause more liquidity drains in our market, or strain. It's going to strain the market just a little bit. Okay. And the ECB is going to be doing the same thing. They've been spending about 60 billion euro, a little over, I think, 75 billion US dollars every month in stimulus. All of this money is going to start being drained out of the market. And then normal market participants, meaning money center banks, global money center banks, sovereign wealth funds, and others are going to have to pick up the slack from the Fed and other central banks, because think of it like a Harper's Bazaar auction, where at the auction, the big dog buyers are the central banks. Well, now when they don't show up at the auction, you need other big buyers to take up that slack. And that'll be other money center banks and sovereign wealth funds and other big money, but they may not be able to pick up the slack as much as the central bank. So that causes a further liquidity strain, causes the bonds to move a little bit lower. causes interest rates to move. Now, I've been talking about this for 2 or 3 months, and even if you don't trade bonds or follow interest rates, you must, because where the bond market goes, it drives interest rates, which then drives currencies, which then drives equities. It spills over the way the money markets work, the way the financial markets work globally. And because technology allows you to move from country to country in carry trade strategies and other kinds of risk strategies, it's just more important now than ever for U.S. investors, even those of you that are at home listening to this. And we've got hedge funds also in our group, hedge fund participants in our group as well, member group. It's very important that you understand the dynamics and the correlations. And correlations don't run forever, folks, as we're seeing now with debt and equity. They start to change. And that transition period can always be a little bit unsettling. What I've got here on the screen is the daily chart of the E-mini S&P 500 futures. Okay, and you can see here, I've got it marked up for you. And I've gone through this with our members a number of times. You can see on the far right-hand side, this bar moving down. It's approximate because I don't have it exactly at the peak and exactly, but it's close enough for government work. You can see here that about a 5% pullback takes the S&P 500 down to 2734. We're at 2757 now, the E-minis where they closed. So we're only about 23 to 25 points to get in our 5% pullback. And anything less than a 5% pullback, we call it a dip. Anything over 5% up to 10%, I call it a pullback. And so dips are just minor noise in the overall scheme of things. A pullback really starts to get a little bit more interesting once you get over the 5% level. And then a correction is an official term, greater than 10%. That's the correction. And then once you get over 20%, of course, you're in a bear market. Now you can see I've run some fib nodes from really the low point as we went into 2018. And you can see how these fib nodes held up just a little bit. And if you look at these shaded zones on the chart, they do represent where buying has come in pretty significantly, right? Where buyers beneath the current price have traditionally come in and picked up equities and buying increased. So you can see right here, there's a plethora of buying. Right in this area here, there's a lot of buying. Right in this area here, there's a lot of buyers that have stood up. Now, all of this is, buying versus selling, and one of them eventually has to win. Right here, the sellers took hold and took us down to this level right here. And then right here at this level, there was another dearth of buying and selling. Sellers took hold here. Now we've got more buyers down at this level down here. And we're going to see if the bears can drive it much lower. You can see the 50 EMA is right here. The 5% pullback takes us down just right above the 50 EMA, right? You can see the trajectory of the 50 EMA is still solid up. And this is the top of the upsloping channel that we've been in all of 2017. So what I'm telling our members is, yeah, we can come down to this fib node here and pull into what we're calling now our S1 zone right here. Should we take that out, notice over here, there are no buyers standing by. So that would probably then take us down to the 2700, another psychological barrier. And then markets always tend to overcorrect both to the upside and downside. That would put us in this area here. And to be honest with you, I would not be surprised at all to see momentum carry us down into this area down here before buyers are willing to come in. And I do believe that big money still wants to come into the market, and the big money is still anticipating the market is going to move higher. And this is more of a clean sweep of the market. It kind of just refreshes. It's kind of like pulling the weeds out and letting the markets grow, right? Now, if I were to take everything off my screen here like this, let me just take everything off the screen. Let's go like that. There we go. And then let's back out a little bit. You can see this big move lower, right? And let's just really back it out a little bit more, okay? You can see here, and this buying volume is based on the duration that I'm showing on the chart here. And you can see there's a lot of buying volume here. And then really the buying volume doesn't kick in again until right around where we opened in 2018. right down in this area here, right around the 2675 area. And then we got some more buying volume down here. So I'm not really that concerned, to be perfectly frank with you, that the bull market is over. I think we still got more run in the bull market. I do believe that we'll probably come down, possibly test the 50 EMA early next week. This Sunday night's open is going to be very interesting. Speaking of Sunday night, for our members, we will have our weekly market watch Sunday night. It'll probably be abbreviated because we do have the Super Bowl hitting. And just as an FYI for those of you Super Bowl fans and those fans of statistics, the S&P performs better when an NFC team wins versus an AFC team. In fact, the S&P performs on average about 10.8% up from the game versus an AFC, which performs at half that, roughly 5.8%. Just looking at the stats of the Super Bowl. And generally, an NFC team translates into an up year for the S&P about 81.5% of the time, versus almost close to 50%, 62% of the time for an AFC team. So that would be, for those of you stat fans out there, that would mean you would want the Eagles to win because they're an NFC team. And as of the close this past Friday, however, the Patriots are a 4.5-point favorite. So anyway, for those of you stat fans out there, I just thought I'd throw that out there. I have to interject into the update. Now, as you can see here, there is no divergences on this chart, so that would indicate that we still got higher to go. And then if you look at the RSI, let me get my indicators back on the screen here so I can show you guys here this real quick. We just went below the 50 percentile level of the RSI. The last time we were below that is back in August. Really, it started in the early August timeframe, right? And we went below. So that tells me that we still have a little bit more to go, guys. And again, I wouldn't be surprised at that. But I think you're going to see big money start to step in, okay? So that is kind of what I'm looking at. And by the way, this is going to be the same across all indexes, all right, across every index that we got. So this, I think, is a good thing. I've been talking about a potential pullback for a while, but I'm also still in a buy the dip mode. And if we step out, you can see just how far away from this upsloping channel, these green lines, this green channel that we've been in, really. And let me just narrow it down here like this. I mean, this goes all the way back to the middle of December of 2016. And Trump was elected in November. So you can see here the pre-Brexit vote lows, the overnight Trump election lows, we were at 2028. And since then, we've just been on a tear. And we've kind of honored this upsloping channel. You know, we generally would brush up outside or down below, but we would quickly find ourselves back in the channel. And then you can see when the tax cuts happen and the markets finally believe that they got the tax cuts through, this is in anticipation of the tax cuts. And now we're just pulling back. So I think pulling back to this channel area, you can see that 5% pullback zone right down at the bottom here, which had kind of put us back into the channel, the top part of the channel. I see that as being highly likely, okay? Now, things could always change, but that's kind of what I'm seeing, just everything else left to normalization mode. If we look at the transports, as I've been telling our members, started giving it up long ago. And look at the transports, guys. We've actually moved into the red just barely for the year for the transports. The transports started giving it up in the middle of January, okay? The financial markets did not start giving it up, really, until going into the end of January. So the transports were a couple of weeks ahead as it started. It tried to make an attempt back higher, and then it rolled back over again. And we're sitting right on the 50 EMA for the transports. And then, of course, if we look at the Dow, let me get the Dow futures up here for you guys. Here we go, right here. The Dow is very similar, right? I mean, if you look at it, we've gone below the 50 EMA. We've had this big pullback here. I could run the fib nodes on here. And you'll see something very similar from the 2017 open, right? So if I were to just come in here and take this level right here and just quickly put it on for the node, you can see right here that we're sitting right at the 0.618. And if we break that, there's a lot of buyers sitting here and, you know, buy over price, right? You can see that right here. There's a lot of them sitting right at the open price right here of 2018. Again, I expect a test of the uh, um, 50 EMA, and I think momentum could carry us a little bit lower. What you've got to be careful of in a market like this, and this is where our flags will go from caution to red. All right, right now I'm in just a cautionary mode. We're in a dip mode. But where they'll start to go into the red, let's say we come down and then we have the inevitable bounce. And the bounce carries us up pretty strong. We'll get a strong counter reaction to this down move. This would be a resumption of the trend. And it's probably going to be a 20 to 40 point move higher because buyers are going to come in and then everybody's going to jump on the bandwagon and say, see, we're in to buy the dip. We got to do it. And they start coming in. And then we get up and let's say we have a little bit of this and we get right in this area here. And then we roll back over again. We don't make new highs. And if we roll back over, one of a couple of scenarios are going to take place. Wherever we finished our downward draft here and then our upward draft, we're going to finish inside that range. Whichever side we break first is going to determine whether we bring up the red flag or stay in the caution or green flag. Caution is we're staying in the range bound area. Red flag is we break that low and we start to make lower lows. Because then what that means is we've now in a little bit of a longer duration dip slash pullback if we go back beyond 5%. So we can have one of these modes come up like that, come down like that, and it's a longer duration. And then what that does is if you plot it on the graph, it'll look something like that, right? And we'll just keep this trend going until we get down to a point where buyers say, okay, we're now ready to come in and start buying again. Remember, the fundamentals of the economy, the U.S. economy, the global markets are very, very strong. So this is just, in my mind, a healthy correction, and we should treat it as such. But however we treat it, we're still going to be subject in 2018 to higher volatility. And I've been saying that as well in 2018. And if we look at 2018, and let's say we just take a look at vol for a second, right? And we look at the vol and we look at the VIX here, all right? It finished up 1716. We've moved into the yellow. We hit a 1719 prior pivot high, right? And if I just move it back, you're going to see where that number comes in. And I just keep going back like that, right? And you can see where that number has been a key for us. We're in zone 2 right now. All right, that's kind of where we're sitting. We're in the yellow. Zone 2 is when the VIX is over 15, between 15 and 22. And it just dictates some of our strategies for us. Now, what I'm going to be watching very closely over the next week is every time we've gotten up into this zone right here, we don't last very long, only for a few days. Now, right here, we really spiked. All right, these were the big spikes that we had back in 2016. This was right before the presidential election, right? I will remind you. That was causing that. And then when Trump got elected, the markets just immediately said, okay, more money's coming in. A business guy is going to run the economy and it should be a little bit better. And whether you're for Trump or for Clinton doesn't really matter to me. I could care less. What I do care about is what their policies are going to do to the markets. And that was the way the markets interpret it. Now we're back up here again. This is driven primarily by that risk parity that I was talking about between debt and equity, and the 10-year interest rate finally moving higher. So we're in zone 2 now. I don't expect it to get much higher. And understand how volatility works, right? It's very difficult to maintain high levels of volatility. As the markets move lower, right, vol goes up. But as it starts here and then ends up down here, the market price, and then if it starts to consolidate here, volatility comes back down again, even though we've moved down. We're just recalibrating the PE levels and valuations of the market. That's all that's happening right now, given the prospects of more interest rate hikes coming. 3 this year are anticipated. I don't think the Feds are going to be any more aggressive than that. If we look at the 10-year, this is what I've been showing our members, right? If we look at the 10-year, let me find the 10-year. Let me come down here to Treasuries, find the 10-year interest rate. Okay, look at this. Let me put it on a weekly, and let's just step out a little bit. And we're going to go back in time, okay? If we go back in time on the 10-year, this goes all the way back, I think, to 1994. This is a weekly chart. You can see just barely right here, all right? This was the peak, 1994. I've got another chart that goes back to 82, and this trend line has been intact. You can see right here, on this weekly chart, we just broke out. That's what spooked the markets. This past week, we had that key breakout over 2.6. I believe we're running up to 3%. If I put it on the daily chart, you'll see what I mean. Key breakout on the 10-year, you've got to follow the 10-year rates. You have to. You have no choice. And you can see this big move higher in interest rates, okay? And here is the big resistance area that I believe we're going to be running to. Now, we're not going to go straight up, I don't believe. We'll probably have a little bit of chop, sideways pattern. But what that's done, look at the bond market. We've been short bonds. I've been playing short bonds. Look at that dive here. I mean, it's just, I mean, every time I seem to open it up, I have to put a new low on here, right? We've already taken out the 2017 lows in bonds. We're getting into an oversold condition, so I wouldn't be surprised to see the markets stabilize a little bit. But remember what I said last Sunday and the Sunday before. This is my target for the bonds, around 140.24, and that would put the interest rates, the 10-year, around that 3% level, guys. So we've been short bonds. I've been playing bonds short, and it's been a wonderful trade for us. So I think this is, and you can see we're at the 2018 lows. We blew through the 2017 lows. The 2018 open was up here at 152. All right. So we're trading bonds to the downside, and I continue to see downside pressure on the bonds. We may have a little bit of a bounce here, but it'll be a dead cat bounce, and then it'll roll back over again. Okay. So that's a little bit about how we're looking at the Treasury market. And then if we look at the US dollar, you know, as fear really starts to grip and volatility starts to come in, you can see the dollar moving just a little bit higher, right? Just a little bit. We're at 2018 lows, but the dollar has been in this unbelievable pattern here. Look at this, starting really here at the beginning of January. This, I didn't extend it up, but this is the beginning of 2017. The dollar has been in this downward channel. We had a little bit of a move higher, but that gave us a 3-4-5 pattern. Elliott wave, this was my projected low. We blew right through it. We spent about a week here, and then we went down a little bit lower. So to me, getting a little bit of a bounce in the dollar makes some sense. Okay, but a weaker dollar also means that commodities are going to be, in general, a little bit more bullish than normal. Okay, so we can see this in the dollar. If we look at the euro, because I said at the beginning of the year, one of my macro views with the euro is that it was going to run up probably to around 125. Here you can see us at 120, almost at 125.7. We blew through my initial level at 121. Okay, remember when we had this regression channel, and I said if we break this, we're running up here, and we did. You can see the 2017 or 2018 open and the low, and then here's the high here. So I think we're going to be in a little bit of a sideways pattern here for the euro for just a bit of time. And that's kind of how I'm seeing that. All right. Gold. Gold, actually, you would think as a store of value and a fear gauge would have come down. But you can see here, gold had a 2018 high price back on the 25th of January, and then it had actually a down move. This was kind of like all hands on deck, let's just unload asset kind of thing, and that's what we see here. Gold hates higher interest rates. It tends to favor higher inflation. But right now, interest rates took hold and moved gold lower with those 10-year yields breaking. You know, so I think longer term gold is going to move higher in 2018, but near term it's just going to be in a range and chop. So it's going to be a little bit harder to play. Oil, our buddy oil, we're still in oil. It was down just a little bit, but we're in this sideways pattern here. We're 23 for 23 successful oil trades. We've got 3 different oil trades running now. We'll take one off next week. We'll add one. And we're just having fun. If you're not in our oil trades in our group, I highly encourage you to come in and join, because we're running on average about 65% annualized returns just in our oil trades alone. I've set up 3 separate portfolios that I'm trading in oil. One portfolio is just $7,000, another one is $25,000, and the other one is $100,000. So you can pick your portfolio and trade the one that we're trading, but they're all designed to hit about 65% annualized return. You can see oil is just in this wider range right here. It's just digesting this huge move up that we've seen since the middle of December 2017. You can see the 2018 open price, just like equities, it's moved up, and now we're just selling off just a little bit. You can see the fib nodes here. I believe that we could see us coming back down to around the 62.50, 62.75 area, and then catching a little bit of a hold there. But by and large, I think the oil boundary's been set for Q1. And I highly encourage you to come in and join us for the oil trades because they're really a lot of fun. All right, everybody, that's my update for the weekend. For those of you football fans out there, we've got the Pats and the Eagles, so it should be a really good game. For our members, I will see you this Sunday night for our weekly market watch. I will try and make it as succinct as possible, but we got to cover what we have to cover. The markets are the markets. But I'll see you guys. If you're not a member of our group, I highly encourage you to come in because this is where you want to be. All right. Otherwise, you guys have a great, relaxing weekend. See you guys later. Ciao.